If you're tired of winning small and losing big, if your account feels like it's stuck in a cycle you can't break, then listen carefully, because the difference between traders who survive and traders who disappear is not talent, not strategy. It's this one brutal truth you've been avoiding. Most traders don't lose because the market is against them. They lose because they're against themselves. They chase, they hesitate, they cut winners short and let losers run wild. And then they wonder why nothing changes. If you truly want to win more and lose less, you need to understand this. The market is not your enemy. Your behavior is. In this talk, we're going to strip away the nonsense, the false comfort, and the excuses, because the secret isn't complicated, but it is uncomfortable. And only those willing to face it head on will ever become consistently profitable. Most traders come into the market obsessed with how much they can make, but the professionals are focused on how much they can afford to lose. That difference in thinking is where everything begins to change. If you don't master your risk, the market will do it for you, and it won't be gentle. Every trade you take without a clear understanding of your downside is not a calculated decision, it's a gamble dressed up as confidence. Risk is not just a number on your screen. It's your survival. It's your ability to stay in the game long enough to let your edge actually play out. Because here's the truth most people don't want to hear. Even the best traders lose often. The difference is they lose small. They've already accepted the loss before they enter the trade, which means there's no hesitation, no emotional attachment, no hope holding them hostage when the market moves against them. When you master your risk, you stop reacting and start executing. You know exactly where you're wrong before you even click the button. That clarity removes fear. And when fear is gone, discipline becomes easier. You're no longer watching every tick with anxiety because you've already defined the worst case scenario. Most traders do the opposite. They enter first, then figure out risk later. That's why panic sets in. That's why small losses turn into account damage. Controlling risk also forces you to be selective. You don't take every setup. You don't chase the market out of boredom or frustration. You wait, because you understand that every trade carries a cost, and not every opportunity is worth paying for. This patience is what separates impulsive traders from professionals. It's not about doing more, it's about doing less, but doing it better. There's also a psychological shift that happens when your risk is controlled. Losses stop feeling personal. They become part of the process, not a reflection of your ability. You don't need to be right all the time. You just need to make sure that when you're wrong, it doesn't hurt you. And when you're right, you give yourself the chance to capitalize on it. That balance is where consistency is built. Most accounts don't blow up because of one bad trade. They blow up because of a series of unmanaged risks, trades that were too big, losses that were ignored, and decisions that were driven by emotion instead of structure. Mastering your risk eliminates that pattern. It creates a boundary you don't cross, no matter how confident you feel or how tempting the market looks. At the end of the day, making money in trading is not about finding the perfect entry. It's about protecting your capital so you can take the next opportunity and the one after that. Because trading is a long game, and if you want to stay in it, you need to treat risk as your first priority, not your last consideration. Once you truly understand that, everything else starts to fall into place. Cutting losses fast sounds simple, but in reality it's where most traders fail, not because they don't understand it, but because they refuse to accept it in the moment that matters. Taking a loss is uncomfortable. It challenges your ego, your analysis, and your sense of control. So instead of acting decisively, traders hesitate. They hope. They rationalize. And in that hesitation, a small, manageable loss quietly grows into something far more damaging. The market doesn't care about your opinion. It doesn't care how much time you spent analyzing a setup or how confident you felt when you entered the trade. Once price moves against you and invalidates your idea, your job is not to argue with it. Your job is to get out fast, clean, without hesitation, because the longer you stay in a losing position, the more you expose yourself to emotional decision-making, and that's where discipline breaks down completely. When you cut losses quickly, you're not admitting defeat, you're maintaining control, you're proving to yourself that you can follow your rules even when it's uncomfortable. That's what builds consistency. Every time you hesitate, every time you let a loss run, you're reinforcing the exact behavior that keeps you stuck. But when you act immediately, when you exit the moment your level is broken, you build trust in your own execution. And that trust is everything in trading. There's also a financial reality you cannot ignore. Losses grow faster than you think. A small percentage loss is easy to recover from, but once it becomes significant, the math starts working against you. The deeper the drawdown, the harder it becomes to climb back. That's why professionals are ruthless with their exits. They understand that survival is more important than being right. They'd rather take 10 small losses than one large one because they know the long-term impact of that discipline. Cutting losses fast also keeps your mind clear. When you're stuck in a losing trade, your focus shifts from opportunity to damage control. You're no longer thinking objectively. You're thinking emotionally, trying to get back what you've lost. This often leads to even worse decisions, adding to losing positions, moving stop losses, or jumping into revenge trades. One bad decision starts a chain reaction, and before you realize it, the damage is done. The traders who succeed are the ones who break that chain immediately. They don't negotiate with losing trades. They don't give the market a little more room out of hope. They execute their exit and move on. No drama, no attachment, just discipline. And that ability to reset quickly is what allows them to stay consistent over time. You have to understand that losses are not the problem. Avoiding them is because when you try to avoid taking a loss, you end up taking a much bigger one. It's not the market that creates that outcome, it's your refusal to act. The moment you accept that losses are simply a cost of doing business, cutting them becomes easier. It becomes automatic. And that's exactly where you need to be. In trading, your edge is not just in your entries, it's in how you manage your exits. And the fastest way to protect your capital, your confidence, and your long-term performance is simple. When you're wrong, get out. No hesitation, no excuses, no second chances. Letting winning trades run sounds like the obvious thing to do, yet it's one of the hardest disciplines for any trader to master. The moment a trade goes into profit, something shifts psychologically. Fear doesn't disappear, it changes form. Instead of fearing loss, you start fearing giving back what you've gained. And that fear is what causes most traders to exit far too early, locking in small wins while missing the larger move that could have made a real difference. This is where the imbalance begins. If your losses are allowed to grow while your winners are cut short, the math will always work against you. You might win often, you might feel like you're doing things right, but your account will tell a different story. Consistency is not built on being right frequently. It's built on making sure that when you are right, you maximize it. And that only happens when you have the discipline to stay in the trade beyond your comfort zone. Letting winners run is not about hope or blind optimism. It's about having a plan and trusting it. Before you enter a trade, you should already know under what conditions you will stay in and under what conditions you will exit. When the trade moves in your favor, your job is not to interfere unnecessarily. It's to manage it with structure, not emotion. That might mean trailing your stop, scaling out at predefined levels, or simply holding until your target is reached. But what it should never mean is exiting just because you feel uncomfortable with the profit fluctuating. The discomfort is part of the process. You will see profits increase and then pull back. You will question whether the move is over. You will feel the urge to secure what you have. But this is where discipline separates professionals from everyone else. Professionals understand that the market doesn't move in straight lines. They accept the fluctuations because they know that the real money is made in the extended moves, not in the small quick gains. Another critical aspect of letting winners run is patience. Most traders are conditioned to seek immediate results. They want confirmation, validation, and profit as quickly as possible. But the market doesn't operate on your timeline. Sometimes the best trades take time to develop. They require you to sit through periods of consolidation, minor pullbacks, and uncertainty. If you're constantly looking for an excuse to exit, you'll never capture those larger moves. There's also a level of trust involved, trust in your strategy, your analysis, and your ability to execute. If you don't trust your edge, you will always default to taking profits too early. You'll convince yourself that a profit is a profit, but in reality, you're limiting your potential. Over time, this behavior creates a ceiling on your performance. You stay busy, you stay active, but you never truly progress. Letting winners run doesn't mean you never take profit. It means you do it with intention, not fear. It means you allow the trade the space it needs to reach its potential while protecting yourself with disciplined risk management. You're not guessing, you're executing a plan. In the end, trading is not about how many trades you win. It's about how much you make when you win versus how much you lose when you're wrong. If you can keep your losses small and give your winners room to grow, you shift the entire equation in your favor. And that's when consistency starts to emerge, not from doing more, but from doing what matters better. Controlling your emotions is not some soft optional skill in trading. It is the foundation everything else sits on. You can have the best strategy in the world, the cleanest charts, the most precise entries, but if your emotions take control at the wrong moment, none of it matters. Because trading is not a battle against the market, it's a battle against your own impulses, your own reactions, and your ability to stay disciplined under pressure. The market is designed to provoke you. It will test your patience, your confidence, and your ability to remain consistent. It will move just enough to make you doubt your position, just enough to tempt you into chasing, just enough to push you into making decisions you didn't plan for. And if you're not in control of your emotions, you will respond instead of execute. That's where mistakes begin, not in your strategy, but in your reaction. Fear and greed are the obvious ones, but it goes deeper than that. There's frustration after a loss, overconfidence after a win, impatience when nothing is happening, and anxiety when everything is moving too fast. Each of these emotions can distort your judgment. Fear can make you exit too early. Greed can make you hold too long or take unnecessary risks. Frustration can push you into revenge trading. Overconfidence can lead you to ignore your rules entirely. And impatience can have you entering trades that were never part of your plan. Controlling emotions doesn't mean eliminating them. That's unrealistic. You're human, you will feel them. The difference is whether you act on them or not. Professional traders feel the same emotions as everyone else, but they've trained themselves not to let those emotions dictate their decisions. They rely on structure, on rules, on predefined plans that remove the need for emotional input in the heat of the moment. One of the most powerful ways to control your emotions is through preparation. When you know exactly what you're going to do before the trade begins, where you'll enter, where you'll exit, how much you're risking, you reduce uncertainty. And when uncertainty is reduced, emotional intensity decreases. You're no longer making decisions on the fly. You're following a script you've already written when you were thinking clearly. Another key element is awareness. You need to recognize when your emotional state is shifting. If you've just taken a loss and you feel the urge to jump back into the market immediately, that's not strategy, that's emotion. If you're in a winning trade and you feel the need to close it early just to lock something in, that's fear speaking. The ability to pause, to step back even for a moment, and to question your impulse is what keeps you aligned with your plan. Discipline is what bridges the gap between knowing and doing. Everyone knows they shouldn't overtrade, shouldn't move their stop loss, shouldn't chase the market, but knowledge alone is useless without execution. Discipline is choosing to follow your rules even when it's uncomfortable, even when every part of you wants to do the opposite. It's not easy, but it's necessary. At the end of the day, the market is unpredictable, but your behavior doesn't have to be. You can't control what price does, but you can control how you respond to it. And that control is where your consistency comes from. When you stop trying to control the market and start controlling yourself, you remove the chaos from your decision-making process. That's the real edge in trading, not a secret indicator or a perfect setup, but the ability to remain steady, focused, and disciplined regardless of what the market throws at you. Following your plan sounds straightforward, but in reality, it's where most traders quietly sabotage themselves. They build a plan when they're calm, rational, and focused, and then abandon it the moment the market starts moving. That's the contradiction. You don't lose because you don't have a plan. You lose because you don't trust it enough to follow it when it matters. A trading plan is not just a set of rules, it's a commitment. It defines how you enter, how you exit, how much you risk, and under what conditions you stay out of the market entirely. It's built from logic, from observation, from experience. But the moment you step into a live trade, emotions begin to interfere. Suddenly, that well-thought-out plan feels flexible. You start making small adjustments, moving a stop loss, entering a little earlier, exiting a little sooner, and each of those small decisions pulls you further away from consistency. Impulsive decisions are rarely obvious in the moment. They often feel justified. You tell yourself the market is behaving differently this time, that this setup is too good to miss, or that you need to act quickly before the opportunity disappears. But this is how discipline erodes. It doesn't collapse all at once. It fades, trade by trade, decision by decision, until you're no longer following a system. You're reacting, guessing, and hoping. When you follow your plan, you remove the need to constantly think under pressure. You've already done the thinking. You've already defined what a valid setup looks like and what doesn't. That clarity allows you to execute without hesitation. You're not trying to outsmart the market in real time. You're simply applying a process that you've already tested and accepted. And that's where consistency begins, not in perfection, but in repetition. There's also a deeper level of trust involved. If you don't trust your plan, you'll never follow it. And if you never follow it, you'll never know if it actually works. Many traders jump from one strategy to another, not because the strategies are flawed, but because they never gave any single approach enough consistency to prove itself. They change direction after a few losses, tweak rules after a small drawdown, and constantly search for something better, all while ignoring the real issue, which is their inability to stick with one approach. Following your plan also protects you from overtrading. Not every market condition is suitable for your strategy. There will be days when the best decision is to do nothing, but without a plan, doing nothing feels uncomfortable. It feels like missed opportunity. So you force trades that were never there to begin with. A solid plan gives you permission to stay out, to wait, to be patient. And that patience is what preserves your capital and your mental clarity. Another important aspect is accountability. When you have a plan, you have something to measure your actions against. You can review your trades objectively and see whether you followed your rules or not. Without that structure, everything becomes subjective. Wins can reinforce bad habits and losses can feel random. But with a plan, you can separate execution from outcome. You can take a loss and still know you did the right thing because you followed your process. In the end, success in trading is not about finding something new every day. It's about doing the same things the right way over and over again. Your plan is your foundation. It's what keeps you grounded when the market becomes unpredictable. And if you can develop the discipline to follow it without deviation, you eliminate one of the biggest sources of inconsistency. Because the truth is simple, the market doesn't require you to be perfect, it requires you to be consistent. And consistency only comes when you stop improvising and start executing what you've already decided to do. Most traders are addicted to intensity. They believe success comes from doing more trades, more screen time, more action. They chase the rush of being in the market, convinced that constant activity equals progress. But the reality is the opposite. Intensity might give you short bursts of excitement, even occasional wins, but it rarely produces long-term results. Consistency does. And consistency is built on discipline, patience, and repetition, not adrenaline. The market doesn't reward how hard you push in a single moment. It rewards how well you execute over time. One great trade means nothing if it's followed by a series of impulsive mistakes. One disciplined day doesn't matter if the next day you abandon your rules completely. This is where most traders fail. They operate in extremes, either highly focused or completely undisciplined, either aggressive or overly cautious. There's no stability, no rhythm. And without that, there's no foundation to build on. Consistency is not exciting, it's not dramatic, it's often repetitive, and at times even boring. But that's exactly why it works. When you follow the same process, apply the same rules, and manage your risk the same way every single time, you remove randomness from your behavior. Your results stop being driven by emotion and start being driven by structure. And once that shift happens, everything begins to stabilize. Think about it this way. If your performance depends on being in the right mood or having the perfect day, then it's unreliable. You can't build a career on something that only works when conditions feel ideal. The goal is to reach a point where your execution is the same regardless of how you feel, regardless of what happened in your last trade, and regardless of what the market is doing in the moment. That level of consistency is what separates professionals from everyone else. Another key aspect is that consistency compounds. Small, disciplined actions repeated over time create results that far exceed occasional bursts of intensity. Taking one high-quality trade a day, managing it properly, and sticking to your rules will outperform taking 10 impulsive trades driven by emotion. It might not feel as productive in the moment, but over weeks and months, the difference becomes undeniable. Consistency also protects you from yourself. It creates boundaries. It limits how much damage a bad day can do, because when your actions are structured, even your mistakes are controlled. You don't spiral. You don't lose control, you take the loss, you follow your process, and you move on. That stability is what keeps you in the game long enough to improve and grow. There is also a mental shift that happens when you embrace consistency. You stop chasing outcomes and start focusing on execution. You're no longer obsessed with how much you made or lost on a single trade. Instead, you measure success by how well you followed your rules. Did you stick to your risk? Did you wait for your setup? Did you manage the trade according to your plan? When those answers are consistently yes, the results take care of themselves. The traders who succeed are not the ones who have moments of brilliance. They're the ones who show up every day with the same mindset, the same discipline, and the same commitment to their process. They don't need to feel motivated. They rely on routine. They rely on structure. And they understand that progress in trading is not about sudden breakthroughs, it's about steady, controlled improvement over time. In the end, intensity burns out. It leads to emotional decisions, overtrading, and inconsistency. But consistency endures. It builds confidence, protects capital, and creates a path forward. And if you can commit to that, to doing the right things the same way, every single day you put yourself in a position where success is not a matter of luck, but a natural outcome of your behavior.